All right, let me say hello and welcome to another whiteboard lesson. Doug here with thelincolnlist.com. I got a great topic on tap for everyone today. I'm going to be talking about how to use options, most specifically selling calls and selling puts as a means of getting ownership of a stock at a better price, using that as a hedge in maybe volatile markets or uncertain markets, or just using it as a trade to generate cash for your portfolio. And I promise while I'm going through this, I'll do my very best not to confuse everyone, including myself. Now, before I get started, if you do need help with your trading, take a moment, visit thelincolnlist.com. Also, if you like this video, click that you like it. And if you want to keep up to date with this channel with the educational material like these whiteboard lessons, like the happy hours and the weekly market mutterings, just go ahead and show your support by subscribing. So let's first make sure that we're all on the same page and we understand what selling calls and selling puts means. And I'll try to do this without confusing everyone. Now, normally when you're talking about options, most people are buying them. So when you're buying a call, in theory, I'm going to put air quotes for theory because there's many different theories behind it. But the basic theory there is if you buy a call, you want the stock to go up. If you buy a put, you want the stock to go down. Now, when you're selling them, it works in reverse. So that means when you're selling a call, rather than actually outlaying money from your account, you are taking in a credit. So when you're selling a call, you would like the stock to stay right where it is, or you would like for it to go lower. On the other side, the put side, if you sell a put, again, you're taking in a credit, and you would like the stock to stay right there where it is, or you would like to go higher. Now, if that's a little bit confusing, don't worry, we'll talk a little bit about that here in just a second. But if you know absolutely nothing about options, maybe take a moment just before watching this to just get yourself a familiarity, is that even a word? A familiarity with selling calls and puts. Now let's move into why a trader or an investor may want to do this. Now there's three main reasons. And I mean, there's hundreds of reasons, but there's three main that we're going to talk about. Again, there's a lot of different ways you can do this, but we're going to try to keep it with the basics. Three main reasons. And those are ownership, survival, and cash. And we'll talk about each one of those. So let's first talk about ownership. Now I know each and every one of you, if you've traded, have been in a situation where you have said this: damn, I wish I would have bought that stock at such and such price. If that stock would ever pull back down to this price, I swear I'll buy it with both hands. You ever said that? Or have you ever missed out on the opportunity? So when we talk about ownership, maybe there's a stock out there that you want to own, but you just do not want to own it at the price that it's currently trading. Maybe you've been waiting for a week or 2 weeks or a month for it to pull back, and you said, hey, if it pulls back to this number, I swear I'm going to buy it. It just won't do it. This will give you a chance. By selling options, you can generate cash while you're either waiting for this to come down, or you could just use it as a trade. So let me explain. I'm going to use just hypothetical examples here right now. And again, these numbers aren't accurate because I'm not looking at a brokerage account right now. I'm just going to give you some hypothetical scenarios here, and then we'll go with it. And this is definitely something that if it interests you, you'll have to look into a little bit further. But let's say that you want to own Apple at $195. Okay, we're going to use Apple, ticker symbol AAPL, at $195. But right now, it's nowhere close to that. You need like a $15 or a $20 pullback, or you need a heavy sell here to get you down to that price. And you've been waiting, it just won't show up. Now, one thing you can do here is when we talked about selling calls and selling puts, is when you're selling a call, you want the stock to go lower. When you're selling a put, you want the stock to go higher. Now, one of the things rather than buying is buying gives you the right to own a stock. Buying an option gives you the right to own a stock at a certain strike price. Selling it obligates you. So meaning that if it actually gets down to that price, you're somewhat obligated. Now there's definitely some trickaroo in there that you can roll it and do all kinds of other fancy stuff. But again, the basics. But you're obligating yourself to do it. So one thing that you can do here is you can go down to the option market and you can pick the 195 strike or somewhere around that, and you will find a premium. Now for this example, let's say it's $2, okay? Now this will definitely vary depending on when it expires. The further out in expiration, the higher it will be. Again, this is just for a demonstration to give you guys an idea of the power of using option contracts. So what this means, as I said at the beginning, it gives you a credit, right? A credit. You're not outlaying it. So this is based on one contract. We'll stick with 100 shares. So if you were to outlay 100 shares here, this would be $2, so that equals a $200 credit. So if you sell this put, that means your brokerage account will give you, or basically deposit into your account, $200. Now that sounds good, but now what happens? Well, first of all, if you're dead set on owning something like this stock, and you swear that that's where you'd want to buy it, if that stock stays above $195, I'll give you a couple of scenarios. Let's say it stays above $195 up to your expiration. That means you get to keep this $200, and that's it. Now, if it goes below that, remember I said you're obligated to own this stock. So at this point, if it goes down to 190, in theory, you are long from 195. Now, obviously, just from the first glance here, this presents an enormous amount of risk sometimes because this thing could go to 180, 170. Again, it all depends on market conditions, your thoughts and feelings about a certain stock. But the point here is to understand that a lot of you find yourself in a situation where you want to own a stock, but it will not come to your price. By selling a put in that fashion will allow you to at least draw some income or draw some money while you're waiting and being paid for being patient on your stock. So if it comes down there, you'll just take the stock and that's it. Okay? You'll still get to keep the 200 even if you take the stock. Okay? So it's a good way for you to generate some cash for your portfolio while you are waiting for a certain stock. Now, if you want to be short a certain stock at a price as well, maybe you want to short this if it went to 220, you could do the same thing. You would just want to sell a call at the strike. You would be willing to short. Now, again, just like the stock can go down several $10, $20, $30, it could also go up and squeeze $10, $20, or $30. So make sure you have a general understanding of the risk parameters when you're doing something like this. But the point is, if you're interested in owning a stock and it won't do what you want to do, and it won't come to the price, this is a way for you to at least get something on that while you're waiting. Now, the next piece of this comes from survival, which is hedging. We all find ourselves every so often in a position where we feel that we have a trade or a stock and we think it's going to work. We're pretty confident it's going to work. It's just not working out in the time frame that we want to. We need a little bit more time. We want to buy some time because we know the trade's going to work out. But for right now, we would like to just generate some cash or try to stay surviving in the trade, hedging. So let's say, for example, you own a certain amount of stock. I'm going to give you two examples. One, you're doing a trade. One, you're owning a longer term stock. So let's say for some of you out there that have 401ks and you're long-term investors of Apple and you're collecting a dividend on this stock and you intend on holding this. You're like 30 years old. You intend on holding this till you're 60. You have no interest in selling this. But you think that maybe towards the last quarter of this year that it's due for a downturn. Maybe for whatever reasons you think it's probably not going to go much higher for this year. Let's say that's your analysis. Again, what you can do is you can sell some premiums against that position. So let's say that you own this already, hypothetically, from 190, and you are sitting on some gains, but you want to hold this for the rest of your life or until you're 60 years old. But you think it's going to go lower. You can go into the option market and you can go down to maybe the 180s or the 170s or something like that. Excuse me, not to go the other way. I'm going to wipe that off. Let me get a mess. You would want to go up here higher. Excuse me. We don't want to go lower. We want to go higher. Okay, so let's say the 220s. And you would sell some calls, some 220 calls. See, I confused you already. So forget about this part. You want to sell some 220 calls. Now what this does, let's say they're just 75 bucks or whatever it is per contract that you own. Maybe it's not a lot, but if you expect it to go down, then this is a way for you to collect $75 per contract or $100 per contract while the stock is actually going lower. And you have a lot of power here because you're hedged. Now, if the stock goes up and gets to that level, you'll get to keep the money from the 185, the 190 that you own it to the 220 plus the premiums. But the point here with this example is to let you know that if you have something like this and it's either a dead stock, it's dead money and it's not moving anywhere, or you anticipate on it going lower, the best thing for you to do is to sell calls against that at higher strike prices. By doing that, that allows you to take in cash while your stock is just laying there, just dead. Now, one thing about a lot of these options, especially on a company like Apple, is there'll be weekly options. So this is something that you can do weekly, bi-weekly, or monthly. Again, the further you go out in expiration, the bigger the premium. But again, another example that if you're just sitting here on dead money and you intend on holding a stock because you're collecting it for a dividend, don't let it just sit there and just collect cobwebs. Go to the option market, get some cash from it, and use that. Let that just be another way for you to make money. The last part we'll touch on here real quick is cash. Now, these can be good just for a trade, okay? Now, when you're doing it for a trade, it's the same thing. You want to collect the cash and you want the stock to either stay at or lower or at or higher, depending on what direction, than your strike price. So again, we'll stay with Apple, and let's say today you're trading at 210 bucks, okay? You feel like, hey, this market's kind of, I'm just giving an example. This is not the current state of the market, but the market's not so volatile right now. This stock seems really strong. I think it's going to break out. It doesn't move around very much every day. Maybe dead money, right? It's just sitting here, not doing a whole lot. I don't believe by Friday or by next Friday, this stock touches 200 bucks. I just don't think that's going to happen. I don't believe that's going to happen. And I'm pretty confident that's not going to happen based on the way that it's trading. Again, theory. You can, again, go to the option market. And because we don't think it's going to go there, we would want a put. So you could sell a put here. Let's say, for example, it's just 50 bucks for 100 shares. You take in a $50 credit, $100 credit, $200 credit, $300, whatever it may be. But again, rather than playing something and depending on the stock to go higher, or if you're short to go lower, or to get that immediate move, you don't need that. In a trade like this, you just need the thing to sit still. If it does nothing at all, perfect. So in any one of these scenarios, if the stock does nothing, perfect. If it only goes down a little bit, perfect. If it only goes up a little bit, perfect. Because in most of these situations, you're giving yourself $5, $10, upwards of $20 worth of room. So you don't need a stock to move. So if you're looking for ownership, this gives you a way to draw cash from a stock that you're hell-bent on owning, and you're being paid for your patience. For the traders out there that find themselves in difficult positions where stocks move against them, they're being squeezed on a short, perhaps, or they bought along and it isn't working out right away, you can go to the option market, take in cash while you're experiencing the drawdown, allowing you to survive in that trade and live for another week or another 2 weeks until it really starts to play out in your favor. Or for some of you out there that are just looking in dead markets, dull markets, or stocks that are well behaved with great chart patterns, and you want to take in cash, but you're unable to get any premiums to the upside or downside. When I say premiums, or any kind of real solid moves out of your stocks or out of your trades, it's another tool in your toolkit for you to take in money in dead markets. So if you guys are interested in something like this, I highly recommend that you do a little bit more experimentation and a lot more research and study with it. They have their advantages, but they also have their disadvantages, which I can't get into every one. But you have to understand that the risk on a short, perhaps selling a call, could be unlimited. I mean, a stock can go up $100, $200, like a shop. If you sell calls against that thing, you're going to have trouble. So you've got to be prepared for that and understand the risks. The point of today's whiteboard, without trying to confuse everyone, is to give you another tool that in certain situations, in certain market environments, and certain things that you will encounter, selling calls and selling puts will give you an advantage. It will allow you to take in premium, it'll help your portfolio, and it has a lot of great advantages. It has its place, and that's why they're there. And if they're there, you need to be able to use them. So if you do need help with that, you can always trade with us at thelincolnlist.com. If you have more questions about that, please put them in the comments section or send me an email, support@thelincolnlist.com. Thanks for watching this whiteboard lesson. Until next time, Take care.